All right, we're back with you on a Monday morning. Hope you're having a good one out there. You know, this morning, USDA had another announcement that we actually had sold some grain over the weekend. I guess technically, I like to call it grain. Some folks disqualify soybeans as being a grain, but soybeans, oilseed, whatever. Soybeans, 132,000 tons were sold to unknown destinations over the weekend. No matter how you slice or dice it, that was positive news for the ag trade. But let's see how the market is reacting. It did not have any corn sales and no wheat sales. So the corn opened up a penny higher this morning, and now we're down 2 on the March at 483.5. Well, that didn't last very long. May is down 2 cents, and we're at 495.5. Soybeans, they were about 13 higher overnight. Then they went about 17 higher after the open, and now we have the March 21 3/4 higher. Now we're at 13.44 3/4. So there must be more to the story here. We'll check in on that here in a moment. Right now, we're trading about a penny and a half off of our high that was made after the open this morning. Okay, now in the wheat here in Chicago, March is down 16 cents. What's going on here? 615 3/4 now. That'd be your last trade, and we had been as high as 633 1/4. So an about face in the Chicago wheat. How about Kansas City? Yikes, we have March down 20 1/4 at 640 3/4. That's not a strong start. We're now just one tick from our low of the opening range. In the spring wheat trade in Minneapolis this morning, March is down 7 3/4 at 721 3/4. Remember, cotton, we did have some gains this morning. We still do. We have March up 45 points at 81.89 per pound. For a while, we were over 82 cents, and we're just a little bit under it, at least at the moment here. So we have Mr. Chris Swift with us in studio. He's with Swift Trading, based in Nashville. Glad you made it through the stormy period over the weekend as well.
I hate for everybody that had to go through it.
Yeah, we were all fairly close to something that happened out there. But anyway, now that we look at the markets here, things are just kind of, I call it a bungee market. When you have soybeans going sharply higher and you have wheat going sharply lower now.
Right.
They're just pulling apart. What's with that?
Well, I think a lot of it hinges on the USDA report that we got on Friday, the WASDE report, and it pretty much showed nothing. There was absolutely nothing in that report that changed anything. So today I think we're dealing with the wheat having been 7-8 days in a row up. Now we're taking it back down again a little bit because the wheat crop is in really good shape. The beans, probably a lot to do with South America. Some areas got some really beneficial rains over the weekend. Others did not. Maybe the ones that did not are a little bit more important than the ones that did. But other than that, along with the sale that we had this morning, probably a little bit just firmer market for the day.
Do you think there was a change in the Brazilian weather forecast maybe this morning?
It's possible. I haven't seen anything yet that would lead me to believe one thing or the other. And, you know, beans have really been stagnant, and so too has corn. So we're not really looking at much of a breakout or anything like that. And I'm not real sure that there's going to be just yet, at least till the first of the year.
Do you think the spread relationship between corn and soybeans means much right now?
Yeah, probably so, because we had seen beans travel back over corn, or at least I think it was either $5 or $6 back over corn again, and it set new highs as far as the width of beans over corn. Then it's kind of come back again to a little bit of a double bottom right now.
So when you look at, let me bring up the corn table here, the corn price table. When you look at the structure here on this, is that encouraging storage or not, in your opinion?
Well, it's very much encouraging. Any kind you got a carry charge market, it encourages you to store that grain. And of course, we have always believed that that's bearish when you get into the storage because they're begging you to hold on to it. When we look at bull markets, they'll pay anything that they want to right up front because they need it. Here they're saying, we don't need your corn, store it till the back end when we may need it.
What about on soybeans? If you look at the structure on soybeans, what is that one telling
Well, and
you?
it's still in full carry, but maybe not full carry, but when we go out May, July, those are the tightest ones there. And of course, that goes to the tail end of usage right there and the very front end of the harvest from South America.
So if you look at the new crop December corn for next year, does that look appealing at all or not? I mean, that is one boring chart if you go beyond
It really
August.
is, and look at the price, $5.11. We have to understand, is that above or below the cost of production, and right now we believe it's kind of dead even, so there's not a lot of profit margin to it. We knew we were larger in acres in corn this year and shorter in beans, kind of anticipate a swap in that next year, go more beans than corn. And that might give corn a little bit of a boost. But.
So it's hard to go to an ag banker and sit down and say, I need an operating note because here's my spreadsheet and it shows I can break even at the end of the year.
Yeah, it really is tough. But of course, then you got to add subsidies onto that and all kinds of other things. And there's some that are really good marketers that have a price already established at a much higher level than this.
If they were good about it last spring.
If they were good about it. And believe it or not, there's some people out there that do that. You know, if you look at the big grain elevators and stuff, they're there to manage risk. And so, therefore, they're managing their risk. Even if it's not the top or the bottom, they've managed the risk.
I remember when we had corn up there $6, $7, and people were forward pricing maybe 2-3 years worth. And, you know, you had to wonder, well, it's kind of risky.
And wheat at 12, 13.
And now it looks pretty good. Yeah,
sure,
exactly.
Absolutely.
Yeah, good point. Okay, we'll come back and we'll take another look at our livestock trade with this guy when we come back. All right, we're back talking with Chris Swift, and now let's delve into the realm of livestock trade, shall we? Let's go to the live cattle board here, and right now we are down by 57 cents on February. We're at 165.15. Now we're about 90 cents off of our earlier high that was made after the open here. In general, I'll call it 45 to 60 lower. On feeders, we're starting to sag now. You have the March contract $1.65 lower. We're at 214.42. And wow, that's a couple of bucks already. More than that, about $2.50 off of our earlier high this morning. April feeders are down 152 at 217.67. Let's flip the page and let's take a look at lean hogs this morning. Well, you know, earlier we were higher and now they have turned around. So we have February lean hogs reversing out to go to 68.27 now. Now we're down 70 cents on the day. My goodness, we were about $2 higher than that here early at the open. April lean hogs down 60 at 75.52. It seems like everything other than soybeans is really struggling right now.
They kind of are.
What's the story on livestock here?
Well, in the beef market, it's kind of interesting. Boxes have fallen off pretty readily. We're down to about 188 right now in box beef. Going forward, it's going to be a balancing act. It's going to be trying to find margin, and the packer's not going to want to facilitate a slaughter large enough to be able to handle what the producer wants right now, and that's because we've got elevated numbers of cattle on feed, another new record carcass weight coming in, so we are producing more beef with fewer cattle. It's going to stay that way for a while. When we look at the hog market's really interesting because right now it's not doing anything. We're seeing large premiums in the back end, June, July, and August, which is not uncommon at all. But we saw last week where Smithfield Farms already broke some contracts with Utah, about 26, 27 producers out there. That's telling us there's too many hogs out there. We've seen Hogs and Pigs report multiple quarters in a row, dead even to 1% higher, so we're not cutting back on anything. So I think we're kind of overproducing in pork, and that deal with Smithfield Farms in Utah was a big clue as to what's going on in the pork industry.
And it seems like the supply is really front-loaded in China, too, as everything
absolutely.
comes to market right now.
So we want to be really careful on the hog market here and expectations of what it might do, because we know seasonally June, July tend to be really good months, and they just might not be this time.
Interesting. Well, thanks for sharing all that, and thanks for coming in.
Absolutely.
Chris Swift of Swift Trading with us here on a Monday morning. Tammy, back to you.